5 stocks that dividend investors are buying right now. First one, Verizon. Now, Verizon's a company that Berkshire Hathaway owned at one point, and if you look at our past videos about it, we were just confused by that. I didn't understand why. My biggest reason was this.
Still don't understand why.
Yeah. Well, I don't think they own it anymore.
They don't anymore, but...
$158 billion market cap. This means if you bought every single share outstanding, you would have to spend $158 billion to own all the shares on the market. But look at this enterprise value, $440 billion. Essentially in between here is the total debt. That's essentially the net debt in the company. So I look at this saying, in a rising interest rate environment, and we were saying this before rates even went up from 0%.
This was like 2-3 years ago.
Well, 2 years. I think we weren't making, 2 or 3 years ago. Yeah, you're probably right.
Yeah.
And that just made no sense to me. They pay a huge dividend though, and people love that.
That's the attraction.
$11 billion. But here's the deal, guys. For the dividend people out there, you have to remember, don't just chase dividend yield. You got to sit there and make sure, can they afford it? And is the company a reasonably priced company? Now, look, you might sit there and say, hey, the PE is only 7.6. The 5-year PE is 8.2. Guys, $13.7 billion in free cash flow last year. Look at their net income, though, $21 billion. That's a big difference. 5-year net income, $19 billion. 5-year free cash flow, $7 billion. That immediately I just go, bleh, not interested in it. I know a value investor that I respect greatly who still has this stock. I'm not going to mention who. Not for me. What do you think, Mo?
It's way too difficult. Actually, the whole telecommunications space is this way.
They love debt.
You do see a ton of debt on telecommunications, and that just rubs me the wrong way.
Yeah, especially, when you sit there and say what happens when their average interest rate even goes up 2% on $300 billion. You're talking about $6 billion of free cash flow gone.
And this is an example of why buy a company that is really struggling on paper. That's what it looks like, just for the dividend.
I just think it's a bad balance sheet.
Yeah.
Okay, stock number 2, Pepsico.
Okay.
Let's look up Pepsico.
Maybe a little better.
I will say, I love Coke Zero, but Pepsi Max is really good as well.
Never had.
Really, really good. Not as much debt here. Dividend yield, 2.8%. But here's the deal, Mo.
Oh my goodness.
It eats up all of their cash flow.
Yeah.
Their 1-year free cash flow is $7 billion. Their 5-year average $6.5 billion. Their dividends are $6.5 billion. I look at that saying, okay, you're also paying 33 times cash flow and 28 times earnings to get that. And again, free cash flow is lower than earnings.
Yeah.
I don't know. You have to sit there and say, what's the attraction here when you're paying 33 times free cash flow? Good return on invested capital, 15%. Good 1 year, 17%. So I look at these things thinking, okay, this is better than Verizon. Way better than Verizon. But again, if there's any sort of hurdle that happens, what are they going to do with this dividend? It's going to be the first thing they cut. Yep. Why? Well, guys, they have to sit there and save their money somehow. If all of a sudden their free cash flow drops 20%, how do they afford that dividend? Taking on debt?
No.
I don't want that.
I don't think they would.
Let's see what analyst estimates are saying for EPS. Mid to high single digits earnings per share growth. So I imagine the free cash flow will be the same way. But again, the free cash flow is trailing net income over the last 5 years. Why would that change? I don't know. So for me, again, I'd rather have this than Verizon.
Absolutely.
All right. Stock number 3, Cisco. Now, this is the company that back in 2000 was going to be the first $1 trillion company. It hit $500 billion. All the articles were saying first $1 trillion company. Guys, I just want to show you. It has not reached the 2000 peak yet. 23 years later, it has not hit that peak. The peak was March 27th, 2000, $82 a share. It has never hit that since. The closest it got was December of 2021, hit $64.28 a share.
So it's never even become a $500 billion company.
Since, correct.
Yeah.
Forget about trillion. Yeah, forget about trillion. All right, now this company. I will say, dividend yield of 3.1%. Dividends paid 6.3.
Okay.
Last year's free cash flow, $17.5 billion. 5-year average, 15. Mo, look at their net income. 1 year, 13.5. 5-year, 11.6. So guys, again, I reiterate, now their free cash flow is greater than their net income, which is not what we saw with Verizon or Pepsi. And this dividend yield,
very affordable.
Business would have to really do poorly to get that.
This is a company where just based on those little things, I'm like, okay, I'll look a little bit more.
Yep. Now, price of free cash flow is almost single digits. PE, a little bit higher. That's okay, though. Good, solid return on invested capital. So far of the three, this is by far the most attractive. Now, you might sit there and say, Yeah, but it's, it's gross. It's Cisco. Yeah, I get you. I got you.
So is
Mid-single
Verizon.
digits EPS growth, low single digits revenue growth. Remember, guys, just because a company doesn't have a lot of growth potential does not mean it's not a good investment. If you have two companies, they're exactly the same. One's going to go 20% a year, one's going to go 5% a year. Which one will you pay more for?
20%.
20%. However, if the 5% grower is selling for 5 times free cash flow and the 20% grower is selling for 200 times free cash flow, which one's a better investment?
First one.
Probably the first one. And that's the whole idea behind value investing, is realizing that there is a price that's too high to pay and there is a price that's low enough that it makes sense to do so. And I could be ignoring that with Pepsi and Verizon. But I look at Cisco going, I like the balance sheet more. I look at our 8 pillars, 8-pillar stock, 1.7 times the 5-year free cash flows or debt, way more manageable. They're buying back shares. I don't know. This might be to me, this is the best one we've seen so far.
Yep. This one's definitely on my radar.
Yep.
It's on my watch list right
Absolutely.
here. Okay.
What's it on my watch list for? It is on my watch list as well, for $40 a share. Stock number 4, Best Buy. Guys, it's retail. So you have to ask yourself, will Best Buy be able to survive this retail contraction that's ongoing and probably going to continue for a long time? Best Buy is an interesting company from the standpoint of multiples. 5-year average free cash flow, 8. 1 year is 12. PE of 13. 5-year PE of 9.6, 9.7. Dividends paid. They can afford it. $800 million on $1.4 billion. Pays out 4.8%. Guys, in my opinion on Best Buy, I don't think you're buying this for long-term ownership, in my opinion. I think this is one of those things where if it gets cheap enough and makes sense in a short-term play, it could make a lot of sense. Now, of course, your analysis could be different. Don't listen to me just because I'm on the internet here, right? But let's go use Stock Analyzer tool to look at Best Buy. I'm going to pull up Best Buy in our Stock Analyzer tool. The last time I did it was November 13th of this year. Now, guys, you've seen a lot here. This is the only tool you've seen so far, but we have all of these other tools, plus our community of thousands of like-minded investors. If you're interested in learning more about it, go to everythingmoney.com. We have a free 7-day full access free trial. Very simple. Go check it out and go from there. Now, guys, look at these assumptions I made for Best Buy. Mo, look at these. -4%, -2% revenue growth, and 0% revenue growth. Okay? That's pretty conservative. Profit margin. I probably should have gotten more conservative here, but I did 2.5, 3, and 3.5. Free cash flow. Their free cash flow has been higher in every period over the last 10 years. I did 3, 3.5, 4. Look at my PE. 6, 8, and 10. Guys, I sat there and said this is a declining business, most likely. I could be wrong on that, but I got to be conservative. I got to give myself that, hey, what's more likely to happen? That Best Buy grows a lot from here or Best Buy contracts?
Contracts.
I think so too. Okay? Same with price of free cash flow. Look at my desired return, Mo. 14, 16, and 18%. I want to kill it on this thing.
Big.
So you might sit there and say, Paul, you're bidding up too much. Absolutely. I want to kill it on this thing. I want to absolutely kill it on this thing. Hit the analyze button. Okay. Price of 26 to 30. High price of 40 to 50. Middle price of 35 to 40. I have in my watch list at $40. And guys, that's only to sell puts. And I don't even know if I want to buy it.
Yeah.
If I were trying to, the other big reason is it used to be a stock I liked. However, my methodology of buying has changed. I've changed from special situations. Hey, the stock is undervalued. Let me buy it. Hopefully it can go to my value and then sell it. Now I want to own companies for the long haul. I don't think I want to own Best Buy for the long haul.
And you look at this being at $77.50 a share. Let's say you wanted it at $40. You were actually going to buy the stock. That thing basically has to fall in half. So you're going to own it at double the price to get a dividend. That's kind of the methodology
for a lot of people.
Thinking for a lot of people right now.
Yeah, you're right. And for it to fall in half, what happens to that net income? Is the net income? Look at the income overall. It's declining. Let's look quarter to quarter. Last quarter was 9.76. The previous same quarter was 10.6 billion in revenue. So it's declining, guys. Now, doesn't mean they can't turn things around. Doesn't mean something can't happen like that. All I know is if you're trying to own business for the long haul, probably not a company you want to be in. If you want to own business in a special situation, wait for the stock to fall dramatically before you go, let me take a look. AT&T. Guys, this balance sheet is just a cluster F. $118 billion market cap, $400 billion enterprise value. This dividend yield. Now, granted, I will say this free cash flow is huge compared to their net income.
Yeah.
$20 billion in free cash flow. I just look at it. I don't focus on the last year because they had some spinoffs. So $20 billion versus negative 11.3 in net income. Probably a write-off in there. Terrible return on invested capital. So to me, it says AT&T, stop giving your money to acquisitions, expansion. Do me a favor. Buy back shares, pay down debt, pay your dividend. The dividend is huge. If I were AT&T, you know what I'd do? I would cancel this dividend, which all you dividend lovers out there are going to hate me for. Cancel this dividend, start paying down this debt. Make the debt more manageable. And buy back shares. It's selling for 6 times price of free cash flow. Do some sort of combo buying back shares. I look at this going, I don't understand. Apart from that, I'm just confused by this.
Me too.
AT&T has fallen from grace, $16 a share. 10 years ago, it's actually lower 10 years ago. Isn't that funny? That's incredible. Guys, thank you very much for your time.